Welcome to Santander Asset Management Compass session. I'm Delfina Pérez, Head of Global Markets Content, and it's a pleasure to share this session with José Mazoy, our Global CIO.
Thank you, Delfina.
José.
Thank you so much.
And with Francisco Simón, our Head of Investment Strategy.
Thank you, Delfina.
Fran. In this Santander Compass session, we want to share with you our insights, our views on markets and on asset allocation. And well, I think that we all agree that these are challenging times. And well, focus of markets is on tariffs. So let's start with tariffs. Jose, where are we and how did we end up here?
Well, it has certainly been a roller coaster the last couple of months. When you take a little bit of the history of what has happened with tariffs, we started with a very constructive view with respect to the U.S. because of U.S. Exceptionalism. In fact, the S&P reached all-time highs around the middle of February. But then basically what we started to observe was a rhetoric by President Trump that was much more aggressive.
Yeah,
right,
there was a change.
Yeah, it was a change. In particular, we saw that there were tariff announcements when it comes to Mexico, to Canada, as well as China, and also in some industries, right? So, such as steel and aluminum.
Yeah.
There were some reliefs in the middle because he was kind of open to negotiations. So the market took that as a signal that he was willing to negotiate. But then it came Liberation Day, April 2nd, when you saw that President Trump really was very serious about putting what he called retaliatory tariffs.
Yeah, and very high levels, really high levels.
Really high levels, right? So basically, he put very high tariffs, as we know. And then what we saw is that the evolution of the discussions between especially the US and China became quite difficult, right? And the tariffs in China reached all the way to 145%, right? So, of course, the market became quite spooked, right? In particular, the bond market. And the reaction a few days later was to institute a pause in the tariffs. And this pause brought quite a bit of relief, despite the fact that basically the tariffs in China remained pretty much the same, right? What I can say as well is that the level of tariffs has gone from 2.5% at the beginning of the year to almost 25%, which is quite high and is bringing quite a bit of uncertainty to the market. On top of that, what you see is that President Trump's rhetoric relative to Jerome Powell continuation with the Fed has also increased quite a bit of the nervousness in the market, and rightly so, right? But what we've seen is that over the last few weeks, this rhetoric has been coming a bit milder, right? We can talk about de-escalation.
Yeah,
and when you see the month of April, from Liberation Day to the end of April, we are almost where we started, but with a lot of volatility in the middle, right? I would say that the thing that really has changed is that we were talking at the beginning of the year about U.S. exceptionalism, and now we are more in a camp of thinking about stagflation.
Yeah.
Consumer confidence has been affected. Inflation expectations are now higher, right? So even though the market, the economy is showing resilience, there's all now these signs of less confidence in the U.S. economy, right?
Yeah, so obviously the escalation is very good news, in the sense that things are like getting better or looking to get better, but the US tariff is going to be much higher than in the last decades. That is a fact. And that's going to have an impact on US economic growth and inflation. So, Frank, could you just give us some details on how are we calibrating those impacts?
Yeah, definitely it's going to be an impact in the US economy in terms of growth, inflation. The starting point is at the beginning of the year was pretty good. We were seeing some moderation in growth after the previous years that was like really strong. We were just picturing kind of 2.4% in GDP growth for 2025.
Yeah,
and currently now we are projecting growth around 1.2% this year and with high uncertainty. So the starting point was very good. Now it has deteriorated on the direct effect of taxes. At the end, is a tax. Tariffs are a tax for U.S. consumers. And also the effect on uncertainty that is still to be seen, because there's big uncertainty that definitely we believe it's going to affect consumers, it's going to affect businesses, investments. So it's a pretty different scenario as compared to the beginning of the year.
Absolutely.
But okay, we will see how it goes. But at the end of the year, probably we will start to see also some positive news. So we might have some advancement in terms of deregulation in the U.S. Some at least headlines that will be showing out.
That would be linked to other electoral proposals that were there.
Effectively, yeah.
Maybe looking at midterm elections,
Yeah,
2026.
At the beginning of the year, definitely the Trump administration is just going to look ahead and see the target of midterm elections in November 26. So probably headlines are going to be much more favorable. They're going to be positive for sentiment. And also we expect the Federal Reserve, to cut rates at the last part of the year. We expect 3 cuts this year, 2025. So, and we expect them at the last part of the year. So probably we will have better news in the U.S. economy as we progress in the year.
Yeah, but tariffs are going to have an impact on inflation as well. I mean, you
Yeah,
have to.
definitely. It's the direct impact on inflation. On inflation is clear. So these tariffs mean higher prices for U.S. consumers. There's also some uncertainty around how it's going to be translated into prices, depending on
Who's
how
going to
much.
absorb? Companies, consumers, or even maybe some supply shock chains?
Yeah, there could also be supply shock or supply chain disruptions coming from that, adding to price pressures on the upside. So the outlook for inflation, especially in the short term, is quite uncertain, but the risks are clearly skewed to the upside.
Yeah. Well, that is U.S. tariffs. The focus is there. But there are other countries,
Of course,
things happening in other countries, and particularly in the Eurozone. So any good news coming from the Eurozone that could compensate this?
Well, I think that we had like a fantastic start of the year when it comes to the European market. We had quite a bit of a rally, a bit of an unexpected rally, but nevertheless a good rally that came basically to a halt once all this tariff rhetoric by President Trump started, right? So basically the market in Europe also suffered, right? Nevertheless, when it comes to growth, we do see that the Eurozone is well supported. Actually, we are forecasting a level for the GDP of around 0.7%, which is quite good.
With
right?
the environment.
Yeah, exactly. And I think that there are mainly 2 factors that are going to be a tailwind for the European zone, which have to do with the monetary policy, right? So
ECB is there, is cutting.
Exactly. So they are cutting. We expect them to cut at least twice more, and to bring the reference rate to a level of, let's say, around 1.75.
Yeah, and the market is even expecting more. So
exactly.
Depending on the week, 2, 3.
Yeah, so that's going to support the market for sure. And then what I actually think is quite a bit of a landmark is the fiscal stimulus that we are foreseeing, right? So the European Union has put out a plan to rearm Europe that amounts to around 800 billion euros, which is of the order of 1% of GDP, right? So that at a European level. And when it comes to Germany, also quite a bit of an expansionary fiscal policy with around 500 billion euros that are going to be used for infrastructure, which amounts to around 2.5%.
And that was totally unexpected.
Totally unexpected. I think pretty much it came on the back of basically everything that is happening in the US, and definitely is going to support both growth and it should have some implications in terms of earnings and the stock market.
Yeah, and it has had an impact on investment sentiment. I mean,
absolutely. There's quite a bit of good.
Like a game changer for the euro.
It is a game
for
changer.
the Eurozone.
Mm-hmm.
Yeah. So then we have the macro, we have all these views. So what do we do, or how do we build an investment scenario to go
Well,
through these
yeah.
challenging times, Fran?
So at the end, for us in our process, just having investment scenarios is key, and it's part of our analysis process, of our asset allocation process. That it is just joining the best of the worlds, the quantitative world and the qualitative world, based on quant and fundamental analysis. So under this, we have a framework of a base case scenario, central scenario, and some alternatives with some probabilities. And at this point in time, 80% of the probabilities that we assign to our scenarios are non-recessionary. So that's
Okay, so
that's
no
good news.
recession, no hard recession.
In 80% of the scenarios, we're not picturing a recession in the U.S., a contraction of the U.S. economy and globally. And our main base case scenario is a probability of 60%, and it's a light stagflation. Why light stagflation? Because although we see some risks of inflation to the upside, as we were seeing, and with some uncertainty, we are not seeing those risks of inflation like taken to levels that we had in 2022. So it's just having this impact of tariffs, some uncertainty on the supply chain, but the impact should be significantly lower. And the effect on growth, we see that the hit is going to be important, let's say. It's going to affect some quarters this year. It's going to have probably in the third and fourth quarter a significant impact to just progressively recover from that after that. So that is picturing this light stagflation scenario with high uncertainty, especially in these early weeks and months that will be dissipated as we just go through. The alternative scenarios that we're seeing, we have a 20% probability on some more benign scenarios, split it into two. We have a 15% probability in a slowdown. There will be a very mild slowdown from the previous GDP growth that we were expecting. We were expecting 2.4. It will be something below 2%, below trend growth, but nothing so important or in the slowdown that important.
And what do we need for that to happen?
Well,
Those
we
would
will
be
need
good
tariffs actually to be significantly reduced from current levels.
Okay.
The uncertainty around that to be significantly reduced, and then the impact of this uncertainty will be much milder. And then the economies, as the starting point was very good, the balance sheets of both households and companies was very healthy. It is very healthy, actually. The starting point will just be a very like a kind of a net to avoid a sharp deterioration despite the uncertainty. So that scenario that is kind of benign in that sense will mean that markets could be at higher valuations, and
Okay.
we could have like a kind of benign scenario for markets. The other 5% in the positive one will be like a really positive recovery from the current slowdown or the expectation of the slowdown. And the negative, the 20% additional negative scenario will be one where we have a contraction of the US economy and also the global cycle deteriorating significantly. The shock could be intensified if tariffs remain high. The uncertainty is prolonged in time, and this uncertainty, it is affecting investment decisions by companies, affects unemployment, and then at the same time, like the reduction of real disposable income for households, together with the lower employment, the lower wages, and the high uncertainty will prevent them to keep consuming at a healthy level. So that scenario for now, it's 20% probability. It is decently low, but we are just monitoring all the events.
Yeah, obviously we have
Yeah.
to monitor. Let's concentrate on the 80% growth part.
Absolutely.
So we have macro views, we have investment scenarios. So how are we invested, Jose?
All right. Well, so I would say that from an asset allocation perspective, we pretty much base our asset allocation on the scenario that Fran just described. On the one hand, we know that tariffs are difficult or trade agreements are difficult to get by, right? So they take time.
They take time.
So that's one of the
And
factors.
fine-tuning.
Them and so on. They would not be immediate. No? So that I would say is number one. Second, we still do not have full clarity on what is going to be the effect on inflation and what is going to be the effect on
Yeah, we
on-
have
on
to wait
growth.
for data.
Exactly. So
For months
these,
to pass and data to
yeah.
show.
So definitely what we recommend is to follow a very prudent approach. I think that in this context, it is very important to have a very active management and well diversified. When it comes to the main assets that we look into, I think that when we start with equity, we want to take a prudent approach in equities. We favor European equities relative to US,
Yeah.
but still with a prudent approach. When it comes to government bonds and investment grade credit, we have an overweight view on these type of assets because of their carry properties. And again, in this space, we tend to favor more European assets because of the path of
Yeah,
interest
so
rates and so on.
active management
Yeah,
is
active
key
management is key.
in these challenging times and
Absolutely.
diversification.
Exactly. And we're staying away from an underweight position in high yield at the moment because of the riskiness that it
Yeah,
implies.
it's more risky as
And when it comes to currencies, I would say that we are favoring euro and yen relative to the US dollar, given the context that we currently have.
Yeah. So with these guidelines and approach, how do we materialize in the portfolios?
So
Fran,
that's a very
how
good
do-
question because when we dip into the asset allocation and sub-asset allocation, we'll be, as Jose was mentioning, we will be favoring European assets as compared to the US assets. At the end, the idiosyncratic risk is hitting more the US, it's spreading on to other markets, but we also have some idiosyncratic positive risks here in Europe. So we'll be preferring, in terms of fixed income, we'll be preferring European duration as compared to US duration, especially in the long tenors of the curve. We believe that the long end of the US curve could be a bit more volatile than the European one. In terms of overall duration for the portfolios, we will be more or less neutral in the sense that central banks are priced more or less according to our view. So we are not seeing a big opportunity there. The reason to be in fixed income is to be prudent, to be protected under this
diversify?
high
Yeah.
volatile environment. So we'll be just favoring quality, we'll be favoring sorted durations, we'll be favoring IG versus high yields, we will be favoring all those strategies that just take into consideration the volatility in markets that is pretty high. So we'll be favoring more short-term carry rather than carry with duration,
euro
because
approach.
volatility is pretty high at this moment. So volatility and carry does not fit, don't fit that well. And in terms of equities, it's kind of the same approach. We'll be favoring European equities as compared to US equity and even the rest of the world. We have some positive idiosyncratic risks in Europe that we like. And also in terms of sectors and factors, we'll be pretty much preferring that defensive sectors together with some of those idiosyncratic positive risks for
And
Europe, like industrials.
any view on
Defensive.
emerging markets?
Yeah, in emerging markets, we are preferring emerging markets in general as compared to DM. And in terms of regions within EM, we like LATAM.
Okay.
Last year performance was kind of poor. Valuations are not that attractive. So in terms of volatile environments where valuation adjustments are really playing a role, we believe that you're better protected in LATAM. And when you just consider all the regions, probably Asia is more exposed to tariffs than Latin America. So we've been just preferring Latin America as compared to EM, and some positive idiosyncratic stories there too. So Chilean equities is something that our colleagues really like.
Yeah.
So it's a good point here. And well, in general, we are prudent. Also, in terms of currency, we prefer euro and yen as compared to dollar or other cyclical currencies, and we like gold. We are
Okay.
very positive in gold. We've been positive through a structural demand that we see. We were just really favoring gold for the last months, and now even we believe that is good diversifier for the portfolios, and that having gold in these times is a nice complement for portfolios and cash.
Cash.
I was sure you were
Opportunities to
gonna ask
invest
that.
or
cash is we overweight in cash. So we have to have cash to just benefit from the opportunities that may come. In volatile environments, opportunities happen. So we overweight cash, and we're waiting to see nice opportunities to deploy that cash in our portfolios.
Okay, so challenging times, uncertainties in the US, but far promising or more promising situation in the Eurozone, investment scenarios, there are always investment opportunities. Active management is key. So, well, we hope you have enjoyed this Santander Compass session, but there will be more, José, no?
Of course, there will
sessions
be
of
more.
this.
I mean, when it comes to investments, we want to become the client's compass. So please stay tuned, and we expect there to be many more of these sessions. Thank you very much to you both. Really enjoyed the
to
session.
you, and see you here then in
Thank
another Compass session.
Looking forward to it.